High income investing in the low yield world is still a priority for many investors, but the new wrinkle is higher inflation. Plus, don't look now, but foreign stocks, after years of lagging their U.S. peers, are now starting to heat up. Does it last? Joining me is Lance McGray at Advisors Asset Management. Stick around. I'm Ron DeLegge with ETF Guide. Thank you for joining us. If you're here for the first time watching, be sure to hit that subscribe button. Post your comments below. You know I love interacting with the audience. We've got a lot of ground to cover on today's program. Is high income in a low yield world still possible? And what's behind the upswing in foreign stocks? And does it last? Well, here to talk with us about that and much more is Lance McGray, head of ETFs at Advisors Asset Management. Lance, welcome back to the program. Great to see you.
Hey, Ron, it's always good seeing you.
So let's begin with the AAM S&P 500 High Dividend Yield ETF. That's ticker symbol SPDV, which follows S&P 500 stocks with a high dividend yield value orientation. What strikes me, though, about this particular ETF is how evenly its industry sector exposure is spread out. And that's a lot different versus many of its peers, which tend to have concentrated risk in certain sectors or certain stocks. So tell us, how is SPDV able to deliver yield while managing portfolio risk?
Thanks, Ron. Yeah, and so when we're talking about our high dividend value approach, and again, that's a suite of 3 ETFs, with SPDV being the U.S. large cap strategy. When we created this lineup nearly over 3 years ago now, one of the things that we really focused on was diversification. And one of the reasons why we did that was because when we were creating the strategy and creating the methodology, we identified a number of sort of loopholes or boxes that weren't checked with a lot of existing dividend strategies. And like a lot of dividend strategies, our goal was to do a few things. Number one, we wanted to leverage the dividends, right? The power of dividends and identify large, high-yielding dividend stocks, because historically, high-yielding equities have historically outperformed the broader base benchmark. On the flip side of that, though, we also wanted to keep a very close eye on dividend sustainability, because just as important as the high dividend yield, dividend sustainability, or the ability to potentially minimize your exposure to dividend cuts, is just as powerful for long-term capital gains and obviously the increase of dividend income. Now, when we created these products, and with that mentality in mind, it's awfully hard to achieve that with a large portfolio, right? We couldn't create a broad-based benchmark-hugging strategy which targets high-yielding securities, which also offer dividend quality characteristics. And therefore, we had to essentially increase our active exposure. And while we do that, and while we create a more concentrated portfolio to provide that direct exposure of this portfolio, there are risks associated with that. And number one of those is diversification. We have a relatively high concentrated portfolio of roughly 55 names. Now, the way that we mitigate this concentration risk or additional potential for volatility with a rather concentrated portfolio is to do just what you mentioned. By selecting 5 securities from each GIC sector, what we are able to achieve is to provide a very concentrated portfolio, but achieve sector diversification off all 11 GIC sectors. So to put this into context right now, when a lot of dividend ETFs out there may hold, zero exposure to a certain GIC sector or have 25% exposure to high yielding sectors, at this point in time right now, SPDV has its highest sector allocation is materials at 10.5%, and its lowest sector allocation is energy at 8%. So again, by simply selecting 5 securities from each GIC sector, we are able to achieve that sector diversification and try to eliminate the unintentional sector bets that a lot of our existing competitors happen to fall into.
After many years of underperformance, international emerging market stocks have matched U.S. stocks toe to toe during the past year. And AAM has a pair of high dividend value ETFs targeting foreign stocks. You've got DMDV, which owns the international developed market stocks, and then EEMD targets emerging markets. So, what trends are you seeing with stocks outside of the U.S.?
Yeah, it's been a tough go for international and global stocks in general. International stocks, and more specifically, value-oriented international stocks, have drastically underperformed their growth peers over the last decade, right? And this has really been a function of a few things, mainly low interest rates, and secondly, is a premium being placed on revenue growth in a very low growth environment. Now throw on top of that pandemic-induced recession, and it's very easy to see why international stocks, specifically value-oriented international stocks, have lagged the broader base benchmarks. Now, the good news is things have changed recently. Valuations are coming back into play. And we believe as a global economy continues its recovery, international value stocks offer a great value proposition for those looking to add additional diversification into one's portfolio.
Debates about yield income, as you know, Lance, are usually limited to stock dividend yields versus bond yields. And then there's preferred securities crashing the party, this totally overlooked category within the income market, which kind of offers this happy medium between stocks and bonds. Tell us more.
Yeah, I couldn't agree more. I think the preferred market is certainly an area of or asset class it's certainly underutilized. I will say in the current environment that we are in, more and more investors are taking knowledge of the preferred market for the benefits they offer. Number one, as you mentioned, these are hybrid securities. So they do offer the benefits and characteristics of both traditional bonds and fixed income, but they do so while offering a very, very attractive yield component. And the reason why this is the case is because they are a hybrid security, but they do fall lower on the capital structure. Because of where they fall in the capital structure, they often offer higher yields. Now, in terms of preferreds, many people think because they offer higher yields, they come with additional credit risk. And that's not necessarily the case. If you look at PFLD, the only low duration preferred product that we have in the market right now, nearly 47% of the securities in PFLD are essentially investment grade or better, which means you're not investing in junk securities or high yield bonds or debt, like if you are investing in a corporate bond fund. So not only do you get the pickup in yield because of the preferred security, but you often have less credit risk as well. The other benefit of preferreds in this environment is really a low correlation to other asset classes. As you mentioned, these are hybrid securities, and because of that, they offer a low correlation to bonds and traditional fixed income assets. The third talking point, which is really driving a lot of people to the preferred market, is the preferential tax treatment. Last year in 2020 calendar year, nearly 60% of PFLD's income distribution was classified as QDI, which means that instead of being taxed at ordinary income levels, it's taxed at long-term capital gains rate, which is very, very attractive for investors. So in short, not only are you getting additional pickup in yield because of where the preferred security lies in the capital structure, but you're getting a nice pickup in tax preference as well. So for these reasons, preferreds are really drawing a lot of attention. Now, the one thing that really separates our preferred ETF from other competitors is our focus on low duration. As you can imagine, with rates potentially going up and the fact that preferreds do have make distributions, there is duration risk. So in terms of PFLD, what we are trying to do here is offer all of the benefits of preferreds, but we're trying to do it with minimal interest rate risk. And to put this into context, when you look at the broad-based preferred market, the current duration of that benchmark is roughly 4. If you look at the current duration of PFLD, we're sitting below 1 year, which is a very attractive combination of a high yield, which is currently 5.21 from an SEC yield standpoint, but a duration of less than 1. In this low rate environment, in this environment where people continue to search for yield, PFLD and its low duration aspect or focus is really picking up a lot of traction.
One final thing before you take off, Lance. Many dividend ETFs, as you know, have quarterly distributions, but PFLD's distributions are actually monthly. And distribution timing is not something we talk about often, but it is a big deal because the bills are typically due monthly, not quarterly. And monthly distributions can be particularly helpful for advisors that are trying to manage a client's retirement income cash flow. Your thoughts?
Yes, and this is something that's often, again, overlooked by a lot of investors. As more and more people are living on a fixed income, the importance to generate this organic cash flow is really, really important, especially those for living on that income. With that said, all of our ETFs right now, our entire high dividend value suite, as well as PFLD, offer monthly distributions. And this is something that is often not found in the world of ETFs. Less than 25% of ETFs in the US market offer monthly distributions. And this is just another example of how we here at AAM strive to meet the needs of investors and offer strategies that meet their demands. Not only are we generating these income solutions, but we are able to provide them income on a monthly basis so they can leverage that. They can do one of two things. They can organically raise this cash and meet their cash flow needs. Or secondly, they can reinvest those proceeds into the ETF and potentially capitalize on the benefits of compounding.
Lance, we're going to have to leave it there. Thank you so much for dropping by and sharing your insights.
As always, Ron, thanks for having me.
Check out the ETF lineup at Advisors Asset Management. Go to aamlive.com. The link is posted below in the description section. Don't forget to subscribe to ETF Guide TV. Tell us how you've been enjoying our programs like this one, along with ETF Battles and the many others. You can also hit us up on Twitter at ETF Guide. I'm Ron DeLegge. Thanks for watching. We'll see you next time.